Where is the capital? How are you going to help me?
Hello, my fellow Americans, or those from around the globe. Welcome to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone and everyone who believes that everyone should be well housed. I'm Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else about how to make housing more innovative and attainable.
And as always, we're really happy to partner with Built Rewards to continue to bring you these smart conversations. If you have an idea for a guest or show, or have interest in sponsoring an episode, or all of the above, please email us at podcast@thehousinginsiders.com.
That's right. If you like the show, it always helps to give a review, share the show, spread the word so we can keep making more of these for you.
So, as usual, we're going to start with some of the headlines, and I feel like, as usual, there are a lot of headlines to cover. But right now, the biggest headline by far is the wildfires in Los Angeles. And so, while obviously, it's going to be a long time till we really kind of understand the full extent of the devastation there. And as of today, the winds are letting up a little bit, but the fires are still burning. But at least they're allowing some firefighters to get a handle on the containment.
Yeah, it's been difficult to keep track. We know everyone wants to help. It's a combination of trying to John, to your point, of trying to keep track of what's happening where across the city and the wider metro area. And then also, how do you help if you're looking to do that? Some of the things that we've heard about that are the top places that are consolidating resources: the American Red Cross, obviously the World Central Kitchen, the Los Angeles Fire Department Foundation, for all the folks fighting the fire that John just mentioned. So those are the links we'll add to our show notes so that if you're like us trying to support the boots on the ground in Los Angeles, we can do that.
Of course, there's an endless list of things that businesses in our industry can be doing also to support throughout the crisis. So just as we sort of think about that, I want to, Jeremy, maybe pose a question to you, because I think you know this really well. But there are a lot of people that are being impacted by the fires that today have mortgages and are completely displaced. What happens to your mortgage? What should we as an industry be thinking about related to that process?
Yeah, I mean, we've seen wildfires threaten houses and cause evacuations before. I think what was apparent here was the density of the housing that was affected. And so we know there will be thousands of people asking this question. The thing that the industry has set up, and relatively new if you look across 30 years history, but not that new for your mortgage servicer, for the bank or mortgage company that has your loan, is a natural disaster forbearance. So there is a process in place for the servicer to allow you a temporary pause on your mortgage payment in whole or in part as a result of a natural disaster, as a result of a natural disaster loss. I think the one thing that's important here is that it's not automatic. It's offered. There's usually a standard process to claim it or get it, but you have to, in most cases, you have to take steps to go claim that tool, to go use that resource. So the resource exists to get you some time to understand the implications to your home insurance and your payment. You can't just not pay. Ideally, that's what we're saying. Go and find those resources, which will exist, and it will be standard operating procedure for your mortgage servicer to have dealt with a temporary delay of payments as a result of a natural disaster. And typically, you'll hear that called a natural disaster forbearance. So that's the mechanism, John, that you asked about. I think the larger question for me to kind of pose back to you is, the reason you'd want a natural disaster forbearance, you got to get your life back together, of course, but also you're trying to understand the insurance implications. Do I get a check? How do I get that check? When do I get that check? And all of the things about the replacement cost and funding of a home that's been partially or fully destroyed comes back to HOI. It comes back to your homeowner's insurance. So now that we know there is a process in place for mortgage servicers and for homeowners asking that question, what do we know about HOI, and what do you think this means for homeowners insurance?
Yeah, I mean, honestly, I can't speak to the sort of operational side of how insurance is filed and how long it takes. I mean, I'm sure that's going to vary by insurance company, and I think we'll hear a lot more of that. Like you said, with servicers, disasters aren't new for insurers to cover. But I think your question speaks to the broader issue that we're facing as a country, which is homeowners insurance something that's going to be a liquid insurance that we can rely on in the future, or does this fire really spell the end for homeowners insurance? And I think in a lot of ways it potentially can. I break down the insurance business to a really simple question. Insurance companies have to hold money to be prepared to spend money when there's a major disaster. And that money that they hold is equity capital that requires a rate of return. So if you're holding $1 billion against potential flood damage or against potential fire damage, you're trying to charge premiums so you can earn whatever 10% post-tax rate of return on that money so that you can continue having that money. The question is, if those crises become more frequent or bigger and more expensive than you anticipated, well, then you kind of have two problems. One is investors are going to require a much higher rate of return because your capital is at much higher risk, and regulators are going to make you hold a lot more capital. So at some point, the amount of capital you have to hold and the amount of money you have to charge on that capital gets to the point where nobody can afford the premium, or the premium is just so outlandish that it doesn't make sense to afford. And then you have a few options. One is you're going to try to cross subsidize. So I'm going to charge my riskiest people as much as I can, but whatever they won't pay, I'm going to charge to my least risky consumers, which is, why we're seeing some of the odd numbers of insurance premiums going up the most in states where you don't expect it. But it's really because of this effort, like, where am I going to be able to capture a rate of return? And it's going to be in people that don't have to pay a lot, which is in the safer areas. But ultimately, at some point, what's going to happen is the riskiest people are just going to say, I'm going to self-insure. And so now you're losing premium dollars there. Of course, you're losing some risk. And other people in safe areas that are having to pay a lot are going to self-insure. So you're going to have this problem that we've seen with healthcare where people back out. So I am very much a believer that the only way to capitalize an extraordinarily risky type of thing, a 100-year flood type of thing, is by using government money. So I think we've started again the long, slow road to the government having to backstop insurers, but we shouldn't complain about that because government capital is actually the cheapest form of capital we can use. Now, taxpayers should get some return on that capital, but they shouldn't demand the type of returns that investors would return, especially if they're in second loss position. So anyway, that's my long sort of philosophizing about where the insurance industry is headed, but I think this fire really brings it to a head.
Yeah, they say timing is everything. And this is one of those things where the cost of homeowners insurance and the risk pool you mentioned was already kind of getting into the mainstream media. It was getting into the way people were thinking about this because it was hitting the bottom line for homeowners in a lot of areas. Like you said, the coastal areas as well as inland. And now to have a disaster on the heels of that press will ultimately be the thing probably that drives that. And I think you'll hear a lot of people likely complaining about a government backstop, but without offering alternatives. So to John's point, listen for the alternatives. What's the alternative? And if you don't hear one, then it's the lowest cost of capital to ensure the risk pool that we can have and making sure that it actually benefits the entire pool. And that's the question.
It's remarkable that our episode last year, towards the end of the year, with Ivy Zellman, who is notorious for being able to see around corners, she sure predicted this one, and I'm starting to wonder whether or not she was out there setting some of the fires. Of course, she's in Cleveland, so I know she wouldn't do that. But in any case, it's really, to me, quite remarkable that she had the foresight to say that this issue would dominate the issues around housing, which I think it totally has. So, one other way to avoid insurance costs that I didn't mention is a question, Jeremy. I know that we had QB on. We've talked to a lot of modular folks, but well, first of all, can you make housing more resilient to these issues by using new manufacturing technology, or can you make it cheaper to replace housing by using manufacturing? Any thoughts on what we could do there?
Yeah, well, I think that's so this will be a good use case, test case for size and scale of rebuild. That's the first piece you mentioned because I can't imagine seeing some of the neighborhoods we've seen destroyed and then trying to imagine site built construction going street by street in the way that it's done today and actually doing that in a cost effective and, more importantly, time sensitive way. I have a single lot site built home being built, not a destroyed rebuild, but just a brand new site built home in my neighborhood. They broke ground in early March 2024. They're still not in the home. The site is still wrapped around with tarps. There's still lumber strewn everywhere. There's portable toilets on the site for the workers. It's going to be well over a year for one house to get built on one lot. Now we're talking about thousands of houses all at the same time. So I think the only way to think about it is, how would you replace the house better, faster, stronger? And when I say better, they've been designed differently now. To your point about sustainability, I don't know as much about exterior fire resiliency, but I do know that as far as energy consumption goes, as far as thinking about the engineering of the neighborhood and how many of these houses you can put up, how often you would need a crane, in what order, and how much you could do it in a final price, it has been proven by companies like Connect Homes, based in Southern California, who have rebuilt single homes after a fire in Northern California, in the Central Coast. They're now going to be tested. But in most cases, they can do it far cheaper than the replacement cost of a site built for the types of square footage and the types of, especially beachfront properties we're talking about in this case. So I think there's a huge factory build opportunity here. I think you can actually get money back in homeowners' pockets by coming in at a lower than replacement cost if you use the right design. And if you use energy sustainable methods, you can actually end up paying less over the life of the loan. I just don't know how resilient those are to some of the techniques, brush clearing and other things that you might see in Northern California and Colorado when you think of fire resiliency. And again, I still come back to the fact that it has to be cheaper than traditional site built construction, where you can't predict a lot of the resources you'll need when it comes to the lumber, the labor, all the other things. To do each house individually along a street would just take years, a decade even. And so we
Yeah.
have to do it differently this time.
In some cases, it's kind of the ideal situation for factory building because, to your point, you have many, many units that need to be built very, very quickly. The only thing working against it is it's California, who has complex building code rules, has complex environmental protection rules for what you can and can't do. And of course, there's a lot of remediation that will need to happen to the ground, to the earth, and a lot of infrastructure that was damaged, schools and things like that. So, yeah. So, I mean, I without a doubt, it is the least bad approach to trying to figure out how to rebuild these areas, but it's not going to be easy.
Well, you bring up a good point. My mind always goes to the home, focused on single family housing. And I'm thinking about homeowners, and we're talking about paying your mortgage or getting that forbearance, as well as how you're going to rebuild. But you're right. This is an entire commercial real estate question. It's an entire city planning question. When you lose that infrastructure, you lose those key buildings, you lose those cornerstone, whether they're landmarks, literally, in some of these communities they were. And in other cases, they're just the anchor of the things you need every day: healthcare, education, and shopping. And so these municipalities are going to have real questions. Those insurance companies that we mentioned, we were all, referring to homeowners insurance, but there's a massive commercial real estate implication here. So when I kept seeing numbers, I don't know what you saw, John, I kept seeing numbers that were anywhere between $30 billion and $50 billion when people tried to total the price tag. Now, of course, the media loves that because that's the big headline. But the reality is, like, the most costly disaster, largely because of the density of the housing and the real estate that was destroyed.
Yeah, those numbers don't surprise me given the scale and the scope, but of course the human cost is of course unquantifiable, and that's going to be something that is terrible. It's such a tragedy. So we have one more news item to pivot to, which is literally came through somebody else's Truth Social feed that they notified us. But President-elect Donald Trump has announced, or has put forth, Bill Pulte's name as being the next FHFA director. It was announced recently that Sandra Thompson, the current director, had planned to step down, maybe in some ways kind of hurrying up a decision, lest they sort of have to plug somebody in from the existing agency. So the question's been answered. Bill Pulte will be is nominated, and we'll see what happens in his confirmation. But Boy, lots to digest and think about there. I don't think anybody had him on their short list. But Jeremy, your sort of immediate reactions?
Well, the first thing I thought of was, what do I know about Bill Pulte? And the only two things I came up with that I know are, one, with that last name, I knew he came from the home building family. And so, of course, Pulte Home Builders being either the largest or one of the largest, certainly. And then I'm had been following Bill Pulte on Twitter as far back as I think the pandemic. And so, just learning a little about him and his view on community and philanthropy as a follower, just literally a Twitter follower. Those are the only things. And so this is a person who essentially is getting a very difficult job. If what we know or what we've heard to be true about the exit from conservatorship to have to be 4 years or less. I know some people say it's too complicated. I think you and I agree it's going to happen. But much more a financial structuring job if you're looking to IPO two of the largest institutions in the market. And so my mind went first to what I knew, and then second to, that's a tough job to get tapped for, certainly.
A couple of thoughts along those lines. One is, if you do follow Bill on Twitter, you'll know that he's not shy, and I think he's obviously not hurting for money either. So in a way, he fits this Trump mold of somebody who won't take any shit from anyone. If he needs to go get a job done, he's not going to be afraid to upset a few people. And in some ways, the hard job of GSE reform certainly will require somebody with a hard head who's willing to kind of go at a lot of the critics and a lot of the naysayers and all the various things that people are going to throw in the way to GSE reform. So I do think in a way he fits the Trump mold of candidates, and he's certainly interesting in that regard. The other thing that I think a lot about is, of course, he comes from a building background. And as we think about the greatest problems facing housing right now, people don't often sort of put GSE reform at the top of their list. They put housing supply at the top of their list. And so having a builder, or somebody who knows building so well as part of the administration, kind of in an odd place in the FHFA, to me sort of maybe suggests that some of the things I've talked about in the past, for example, should the GSEs go back into acquisition, development, and construction lending? I mean, many people don't know this, but HUD gave them the ability to go and finance builders to acquire and develop and construct homes. I think that's limited to Fannie Mae. Freddie Mac, I think, is not allowed to do that per their charter, but that is certainly permissible. And, another version of that, which I proposed at Fannie Mae, which I know others have proposed after I've left and have pushed the GSEs to do, is something along the lines of a construction to perm lending program that allows people to more easily finance a building project on their own, which today, if you've ever financed construction or if you help people finance construction, you know that it is the shittiest, messiest process you can imagine. And to create a program whereby you get full sale treatment on the loan as soon as day one, where you don't need a bridge loan, a construction loan, so on and so forth, that actually could be a significant help to the industry. So Bill being at FHFA, maybe some of these construction ideas for the GSEs are something to keep the GSEs busy while they figure out how to do GSE reform.
Yeah, I like that's an optimistic tone, thinking through what else the FHFA director might be able to focus on beyond just exiting these two entities. Let's hope for that, because obviously that's a huge thing. I think the other thing you made me think of, just as a more provocative footnote, perhaps, I always think of sort of those business leader appointees coming out of an administration as sort of being at the cabinet level only, and starting to see them below cabinet level in really the nuts and bolts of regulatory agencies for housing, and to the degree we see them elsewhere, is also an interesting trend to think through. You almost think about like, oh, you've got the sort of donor class that comes in with any administration, and then you've got just functionary appointees. This goes beyond that. And that is an interesting observation, but I don't know what it means. But I'm just thinking of it, getting into the actual workings of some of these places like FHFA. So that wraps it up for the headlines, John. Let's talk about our guest today.
Okay, our guest today is particularly timely, especially given the fires that are happening in Los Angeles right now, and the desperate need to reach people and help them at a time of need. Steve Royster, who's joining us, is the head of community banking and marketing at Mobility Capital Finance, or MoCaFi, as they're known. And I am not going to try to explain what MoCaFi does because we have Steve, who's head of marketing, who can do a much better job. So, Steve, why don't you tell us in a couple of sentences what it is that MoCaFi does and how you guys were founded?
Thanks for having me. MoCaFi, Mobility Capital Finance, we are a financial services and technology platform that uses our financial infrastructure as service to get funds, banking services into the hands of unbanked and underbanked communities through our partnerships with public, private, and social institutions. We were founded in 2016, so Wole Kolksum is our founder and CEO. Former director at JP Morgan Chase, 20 years in finance and investment banking, and was really founded on the cusp of the killing of Michael Brown in 2014. We thought that having a financial institution connected to the social justice work could really bring about change in helping to close the racial wealth gap and the financial gaps in general for services for folks who are unbanked and underbanked. And so we've been doing this work since 2016.
One of the things that John mentioned, I know, access to services and access to resources has been huge. And you had one of your biggest, earliest partners in the city of Los Angeles, is my understanding, if I remember, as we worked together some years ago. Can you talk a little bit about partnering with the city of Los Angeles, and then specifically how you are capable, how you are helping with access to services and resources right now?
Sure. Yeah. Particularly timely, as we know, and we're still in LA, working at the county and city level to disperse funds. But yeah, quickly, I mean, MoCaFi, I'd say sort of really right before the pandemic, we were structured as initially an ISO for Sunrise Banks and then Usio at the time, really around the same mission of getting underbanked and unbanked folks into an insured account, and then a pathway to digital finance as a way to remedy banking deserts, whether literally or figuratively, because folks of a particular financial background, demographic makeup cannot walk into a bank branch and get proper service. But what we realized, at the time, this is 2018, 2019, we were making some progress on the consumer side, but it's expensive to acquire customers, and particularly expensive to acquire a customer who is financially vulnerable and from a chronic perspective, right? And we really are still committed then, committed now to banking that customer. How are you creative in doing that for a customer base that has low deposits, quite frankly? We were thinking about, well, how can we partner with government who's providing resources and us being a partner? And we started to get interest. We're based here in the city. We were getting some interest at the time. There were some ideas around turning the New York City ID card into a debit card. So taking those, incentives for the MoMA and the like, and all of the discounts that you had, could you bank folks who are underbanked? And then that started to spread to different municipalities. And what we ended up doing, what we have today, is essentially white labeling our neobanking platform and providing that as a tool to cities who also shared our social justice mission. And the administration at the time, Mayor Garcetti, had, I think, correct me if I'm wrong here, we can fact check it, but something like $1 billion budget, social justice budget, to get folks banked and resources to folks. And we came in as a partner to efficiently distribute those funds in a way that was cheaper for the city, put folks on a path to ensure bank accounts. And then once they got this Angeleno Connect card, is the brand of the card, once they had funds on those cards, whether it be COVID relief, ERAP, I think we dispersed somewhere on the order of some hundred millions of dollars on the cards through those funding programs. And then we had a pathway to get folks onto a demand deposit account, MoCaFi's managed account that we also called the Angeleno Connect demand deposit account, in a mobile app. And then financial education, credit building, you could report rent to the credit bureaus on the card and continue to just evolve that program. And that was the first program. So that was the first sort of major program where we had city administration use the MoCaFi platform to distribute funds and then work with us in the community to do education and wraparound services, some tied to the card, some not tied to the card, but just us as a corporate brand and an entity that wants to build economic development in communities and underbanked communities, communities of color. We partner together and that continues. And we've had some great relationships grow out of that.
So something just dawned on me, Steve. Thanks for that description. One of the things I was going to ask you, but now I think you answered the question, is when you're trying to serve, an unbanked, underbanked community, customer acquisition cost is just necessarily high. It's just a hard group to reach to. I see you have marketing in your title, so you'll know better than I that it's just a hard marketing challenge. And it just now dawned on me that the insight that you guys really had is that cities have these programs that are struggling to reach people because they don't have the technology or the ability to build the way of dispersing the funds. And so by solving that problem, the city in some ways solves a problem of yours, which is getting to the audience that you're trying to get to. Am I thinking about that? So like, just again, not from a sort of social mission perspective, but from a pure business perspective, you guys have found a distribution pathway via city programs.
Absolutely. That's right. So to put our pure business hat on, head of marketing, how do we authentically get in front of folks who need our product and then serve those folks in a way that any good marketing, any good business channel would do? So that's absolutely right. And that was actually core, still is core to our business model, where we're able to generate sort of B2B revenue and then take that B2C as a distribution channel onto our card and other services.
That's brilliant. And then can you talk a little bit about how when the cities, like say the New York program or the one in LA that you mentioned, when they're trying to get the attention of residents to sign up for those programs, are you partnering with them on marketing? Do they have some marketing? Like what's their strategy to kind of overcome the challenge of getting to the people that need to be talked to?
Yeah, it's a true partnership. So, the city we've leveraged access to the normal channels that you would think of, public access television, the actual email addresses where permissible, and addresses of folks who are actually receiving funds. And then something interesting, I'm wearing a hat that says on our block here that was sort of an outshoot of that. We were introduced to a lot of just community-based organizations and folks that we hired internally at MoCaFi. Many on the biz dev side come out of social engagement or city government, and so had a penchant for just doing work and grassroots work on the ground. So what would happen in our sort of direct to consumer activity, we partner with CBOs like a Think Watts Foundation in LA to do financial education. We do event marketing just to make folks aware that MoCaFi and the Angeleno Connect program is here. So even if you didn't qualify for a particular program, there is a bank account. And probably even more importantly, there's a group of people who care about banking folks at a certain financial level and saying, hey, we're providing you with a quality product and we've got some wraparound tools and we may not have everything, but we're partnered with commercial banks and the city and really dedicated to try to help you create this path to financial mobility. And we've used that in our branding. So if you look at our Instagram and our LinkedIn, we're in the city, in LA, working with the city, working with CBOs, a celebrity here and there when we can get to one that's always sexy. And so, all of that stuff sort of helps to build our brand in our initiatives.
So take us back to Jeremy's question. Los Angeles right now on fire. When I've read the headlines, I haven't really dug into it, but lots of misinformation, rumors, the rumor mill circulating. People in need are in a position where they're evacuating. What's the strategy to kind of find the people that need the support right now?
It's challenging structurally from a product perspective. The positive side of the card and the issuance and getting away from some of the cash and the paper is that you don't need the cash and the paper. But the flip side is we do need an address from a KYC perspective or just an address to mail a card. And so when folks are displaced, how do you just get the cards to them under sort of BAU? And so leadership, we're sort of thinking about how to do that today as just the landscape is changing. Like, how do you find folks? And if there's a way to leverage our platform, we'll do that. And so we, our folks who are handling sort of LA and working with that group are trying to figure that out. And then just personally, us again, working with CBOs in the city, just seeing if there are things that we can do to lend just a hand, quite frankly. We've got staff in Los Angeles. We were talking before we went on. We've got folks who, whether personally and professionally, part of the program that are there. So we're trying to just keep our ears to whatever we can do to have a presence. But when we know that when and if the city and county are ready to distribute funds, we are there with a solution to do that. We're equipped. We can distribute funds really on demand at the flick of a couple of tabs in our portal. And so we're standing at the ready. The program is up and running. It has been up and running. And so like you, we're sort of just paying attention and trying to get in and make a difference where we can.
Yeah, this is, Steve, the complexity, even without a natural disaster that you mentioned a minute ago, is a highly complex network of partnerships and relationships to make this valuable for people. And then you add that on top of it. Of course, this is Housing Insiders. So we're watching houses burn in this case, but it's a, hurricane where houses flood. It's, as we know, a number of things that disrupt households and that disrupt people. And when it's a densely populated city anywhere, it can be so tough. I'm kind of curious, as you think about the types of housing assistance or rental assistance that you've been able to support, can you just walk us through some of the programs? Are you tapping into other programs and then distributing them through the card? And then what does rental assistance or other types of housing assistance look like, whether it's during the pandemic? I know you've had experience there, or this. How does MoCaFi look at specifically like rental housing, either emergencies or ongoing?
And one thing to clarify too, so, and when you're in emergency, this won't capture all, obviously, but any resident, LA or otherwise, who has received funds on a government card issued through our platform, those funds can be loaded automatically. And so if God forbid there is someone who has a card that's been impacted and there's some funds to distribute, we can get that to the person right now. It's all, digital wallet connected. So the newer folks or folks who haven't been on the platform present somewhat of a challenge, but we can do that. So that's one way where in an emergency situation, folks who have cards on the platform, we can reload those instantaneously, if you will. So that's one. In sort of normal times, but none of the times are normal. If they were, we wouldn't be sitting here on the podcast. So a lot of our work around the rental assistance piece has been on sort of the technical assistance and the educational component, and we're looking to scale that. So I mentioned earlier, sort of on our block, it really was a marketing campaign that began in Watts, in Compton with Think Watts, who I mentioned, where we were doing, we had this B2B to C model, and we were doing the trade shows and, asked to provide some financial education, credit building. It's just part of our content marketing stack. And it's great to be a part of other events and we're part of the community. But, I said, well, we're actually on the ground serving folks. We're hiring folks on our team who come out of city and social work. Why don't we just continue that and actually do some of the development work ourselves? Let's bring MoCaFi's technology and our people, our commercial banking relationships, MasterCard, Wells Fargo, TransUnion. Let's bring them to our block. This is our block. This is who we're serving. And let's just do a pop-up. Folks get to know us. We popped up in the park, outside, can sort of ask the bankers anything about whatever it is on your mind financially. We put some money on the card, and now you've got a bank account. We've opened a bank account, put $100 on it. And then more importantly, hopefully with that relationship established, then we can continue to grow and educate and provide services. Well, it turned into being a campaign that's sort of grown into a model where we are able to be a vehicle for CRA-driven corporate CSR funding tied to economic development in sort of underbanked cities, really doing community development work where we are putting together programming, particularly around rental assistance and education. We have a campaign called Rent to Home. So we're targeting, aspiring homeowners who are first-time home buyers, where we've worked with Key Bank in Cleveland to do pop-ups / content / digital content. We've worked with Truist in Birmingham, which was really interesting, where we were actually able to connect 10 public housing residents through a partnership with the Housing Authority of Birmingham District with Truist to get fast track to first time homes that HABD was developing as part of the Section 8 voucher program. We work with TransUnion out in LA doing the same thing. We also work with entrepreneurs on the startup incubator side as well. And it's sort of grown into this sort of commercial bank, financial institution funded technical assistance, if you will, that we believe can actually be an on-ramp for us really being perhaps a CDFI, because half of the work obviously is the education. The other piece is the loan fund. We played around with some grant funding. We're not a fund, we're not an equity fund today, but we see MoCaFi through this On Our Block initiative as being uniquely positioned as a fintech that has a social and economic justice mission. And if you put those two things together, we could actually be a vehicle to become a part of CDFI MDIs who are really, in the community. It's a small sliver of the 20 trillion of commercial banking assets out there, but getting that funding in the folks who really need it and having what we think is a qualified team and a platform to be able to do that. And so that's what we've done today, just to get back pointedly to rental assistance, sort of the educational part, some grant funding to identify folks, and we're looking to scale that to get into not only supporting with just closing costs in general, but also getting into to mortgages, at the right spot in these particular areas.
Yeah, I love that strategy, John. You remind me of this all the time, which is don't try too many different creative or other ways. Give people what they need. Just go directly to what people need. And what they need is the card with the $100 on it and the account and the assistance in their community. And I think often, Steve, we talk to people and it's all these different ways, all these different things around the corner and over this. And if just this happens, and what you're saying is, no, we go right to the block. We give them the card. We put the money on it. We hand it to them. And John, you remind me of that all the time. Like, why beat around the bush? That's exactly what people need. And we just give it to them where they live.
And to take it one step further, I mean, we're a startup still, later stage, we're a startup. And, we're trying to figure out how, again, to bank folks who are in a state of chronic financial vulnerability, as we all know, are dealing with, systemically designed segregation of assets, right? And access. To your point of not getting too cute and exotic with the solutions, I mean, I think what we at MoCaFi are attempting to do is use the tools within the system, as broken as it is, particularly for the communities that we're serving, and say, how do we just get cash into the hands of people? Like, at the end of the day, that's what it's about, right? So yes, an incentive is great, but then how do we really scale to get real capital into folks who can buy homes, who are credit worthy, despite the perception that folks in these areas are not? I think there's a way to bank folks who are vulnerable, but we just have to be creative and dedicated to using the tools that are here to get the funds into them. And so it's just that straightforward. And we're trying to do that as a venture-backed startup company and, and all of those challenges, but we're committed to it. But, at the end of the day, folks need access to cash. And that's the issue, particularly from our view of, banking BIPOC communities in general, where, you've been redlined out of opportunities systemically. And so how do we start to correct that? But there's nothing too cute about it other than, like, how do we get cash into the hands of folks in a responsible way?
In the old adage of, if somebody's getting something for free, they're the product. You guys aren't necessarily doing that in the sense that you're sort of really leveraging leads for too much, I don't think. Correct me if I'm wrong, but ultimately it sounds like once you're able to access an underserved community, they have a lot of other things that are potentially services that they need. And you've mentioned a couple of times, and us being housing insiders, I'd love to hear, so when you have somebody underserved, how do you think about the opportunities of home ownership, both in terms of preparing your members, your clients, your consumers for it, and then also connecting them with a bank who may be looking for an opportunity to do a mortgage with somebody who may, meet the criteria for CRA or other things like that.
And not that we perfected this at all, but there are sort of two approaches or two segments, if you will. So just generally speaking, like, as you know, I mean, the home ownership process is a long-term process, right? If you're meeting someone for the first time who's just thinking about getting into a home, and maybe they're not even thinking about getting into a home, but they're in poor quality housing or a housing crisis, and we show up. A lot of that work, quite frankly, in many occasions, it's life coaching and not even financial coaching, right? We've had folks that we've met in the field where we're not even talking about the basics of home ownership yet. It's like, I'm in between jobs here. I have a little bit of assistance. I have a side gig. How do I manage that in a legitimate way to build credit? I'm divorced from, my spouse here, and I got to take care of the kids and all the pressures that come with that when you don't have financial resources. So that's just a whole block that is still rooted in finances, but it's more of an approach of you can actually live your dream. You can actually start to create a path. And we're a partner that can be here with you to do that in the long term, but there's no transaction necessarily on the horizon. So that's sort of one group. And then what we've done to sort of filter that when we're working with a commercial bank, a key bank, as I mentioned in Cleveland, we'll try to pre-screen some of that for folks who may be right on the cusp. And so we've had folks that are on our banking platform that have reported their rent payments through a MoCaFi card, and through permission-based sort of opting in, we can see their credits at a 590 or 620, and maybe they have some savings. And so then we can get into some of the basic financial planning, working with one of our financial coaches, whether that's from the bank itself, our internal folks in St. Louis. We partner with Edward Jones, who's been a big sponsor. And so their financial advisors have come in and done some pro bono work to get folks to a point where now they've got a package to be able to apply for a loan, a first-time mortgage. We actually partner with FinLocker out of St. Louis to white label one of their solutions, the Blueprint, that provides sort of a home readiness snapshot. And so again, it's available. We promote all of these to anyone who needs the tools, but then there is some market segmentation where we try to find folks who are like right on the cusp so that we can still provide the education, the coaching, but then provide that soft handoff to a commercial banking partner. And it doesn't have to be our partner either. These are all, none of this is sort of, to get on our block MoCaFi support, you have to work with this bank necessarily. It really is a holistic approach. So we try to segment, for folks who are just really not ready, but looking for support, and home ownership is an option to folks who are right on the cusp, and they can use some of our tools to get over the hump.
Makes great sense. This has been such an awesome opportunity to hear a lot more about the background. I want to, get to sort of what the implications, what you've learned, and what we can share with our audience about lessons and takeaways from MoCaFi. But let's take a quick second, hear from our sponsors, and we'll be right back. This episode is brought to you by Bilt Rewards. Bilt is a rewards program, just like an airline program, that is centered around your home and neighborhood. But instead of earning miles for flying, Bilt rewards you for paying rent, no matter how you pay. As a member, you can earn points at over 20,000 local restaurants, local merchants, and those points are now the most valuable rewards currency. You can use it to book travel, on Amazon, or even towards a down payment.
Bilt is revolutionizing housing. If you want to learn more, email John at lawless@builtrewards.com. Welcome back. Steve, it's been great talking to you about the work MoCaFi is doing, and particularly you're mentioning, I keep coming back to this because I can't avoid it, which is the complexity of everything you have to do. All the coordination on the ground, on our block, all the partnerships across these large financial institutions. I'm just curious if you could talk us through anybody listening who wants to partner with MoCaFi, particularly on that bank side, that bank partnership side, like the key banks that you mentioned, and Truist and Wells. They have so many asks on their side, and we're just looking for a fraction of their resources to get people going. What have you learned from partnering with these global financial institutions, and how could people listening think about engaging with MoCaFi going forward?
Man, so much. I think the one of the first lessons, sort of working with institutions, you have good people inside of these institutions where institutionally there are issues with getting access to capital, folks who are underbanked and redlined out of homeownership opportunities. But you've got good folks within who want to sort of make a change and see some systemic change. And so that's number one. And we've seen that, we've raised about 2 million or so in these sort of commercial agreements to put education and tools on our block inside the community. So that's one. I think when you find those folks, then the idea is to say, how do we leverage technology? How do we leverage this patient capital and also government resources and capital, which are needed to bank folks who just have low deposit capacity? I love the CDFI program, as I mentioned earlier. I think it's super useful to be able to leverage treasury dollars with private dollars and a fintech, whether it's on our block or others, who actually have the tools and more so the mission to serve this population in a way that puts real dollars in folks' hands, whether it's, from an incentive to down payment assistance to ultimately a mortgage. I think we need to do more of that and funding more of the CDFI landscape to leverage government dollars to do that, because the cost of acquisition is super high.
It sounds like two things. One, layering resources. MoCaFi is really good at coordinating and layering resources so you don't get, sort of siloed into one program. You can actually use all the programs that might help. I'm hearing that. But then it sounds like the second thing is you got to come in. It can't be entirely philanthropic. You have to come into the bank in a part of the bank that actually sees the benefit, takes credit for, and can then point to and say, we did this. It's not entirely philanthropic, though that might be one of the layers. Those seem to be two keys here.
Indeed. And we're a for-profit corporation, right? And so even on our block, the way we position it is, we're a social finance platform for banks and corporations and philanthropists to invest in economic mobility in excluded communities. So homeowners, the communities themselves with financial planning and entrepreneurs. And there is a return for that. I mean, for us, our banking products are no fee to the community, but, like any neobank structure, we get paid on the interchange fees. There are administrative fees that we take from the program to run it. But we do that in a way, if to your point, sort of leveraging resources, leveraging pools of capital, we can do that at a return that works for us and in a way that is no fee to the end user. So that's super key. A third point, just on the community and the consumer side, and hope this isn't too controversial, but if it is, okay. But, we, education is important. But I can see at times where it feels like we're trying to over-educate the community. I find that folks are actually great at managing money and resources for your particular situation. And like when you have less, you learn how to do more with less, which is should not be the case, but you learn to do that. Yes, there's the process of home ownership. There's the process of tax planning and financial planning that we can all learn from. But I think those things, when you know them and when you can teach them, are fairly straightforward. So let's do that, but let's make a real effort to get capital into the hands of folks who are credit worthy, but may not look that way in the traditional financial system. And what you'll find in the community is they know that they're looking for capital. And so brand and education is great, but it's not the end all be all. Where is the capital? How are you going to help me? And that's really the challenge for us. And I would challenge anyone in the industry who's really looking to close the home ownership gap, close the gaps in financing. We don't have to be super creative, to your earlier point, or cute, but we have to be dedicated and using technology as well to be able to bank folks efficiently at scale. And that's what we're trying to do, just leverage these different sources in the capital stack, use our technology. We haven't talked anything about AI, but obviously that's super important, but keeping our focus on the mission and keeping a personal touch with folks in the community in real life. I think if we can mix those things creatively, we've got a real shot at banking communities who don't have access.
Well, first of all, I'm glad for your controversial statement around education, because I think we we continually say that unless education is timely, personalized, and actionable, it's just a waste. It's just sort of being thrown out there to make yourself feel good that you're doing something, but it doesn't ultimately affect change, which it seems like you guys have the experience of being on the ground and how to actually change behaviors and the like, which is amazing. I want to come back to the kind of the business model that you said, because everybody that approaches business with a sort of social mission has to figure out how to fund that business. And one of the ways that you can fund a business is by cross subsidizing. In other words, you have a mission that is for the wealthy because you can charge them money, you can earn money, and then you can turn around and take that product or benefit and pass it on to the non-wealthy, to the low income. You guys seem to have sort of not that cross subsidization model. It's solely focused on the underserved. And of course, the challenge is that you're not going to be able to charge them a lot of money. You're going to have to earn funding through other means and mechanisms. And as you pointed out, that could be philanthropy, that could be government, other public subsidies. And so I'm kind of curious to get your opinion at this point in time, as you guys are kind of looking at your business. And we're hearing things, and again, I'm just going to sort of dispassionately try to lay out the landscape as I'm seeing it. We have a Trump administration that's come in that's sort of unlikely to reinvest in something like rental assistance, at least not nearly as broadly as we've seen it during the COVID time. I continually see headlines of companies getting rid of their DEI policies, more scrutiny coming around ESG. So, in some ways, you sort of have a double whammy right now, where both the sort of philanthropical wings of companies might be moving away a little bit from what they might have done sort of in the immediate post Floyd era. And you have the government now sort of moving in a more, less sort of give money away or use money as the sort of means of supporting low income folks. So how do you see that affecting your business? Is it a big issue? Are you guys so focused on the state and on the ground or local governments, city governments, that it's less of an impact? Or do you see that as something that's going to put pressure on companies, particularly ones like yours that have a focus on social mission?
Great question. Obviously we're having the same conversations. No one can predict the future, but history doesn't repeat itself, but it rhymes. And so, we would think that the trade winds for, social justice investment, DEI, may not necessarily be in our favor. But I think we're uniquely positioned in that we have, in our cap table and our client partners, we have strong commercial banking relationships for, the business model that we discussed. So distribution of programming. BNY is a huge partner. We were actually just awarded with BNY the Direct Express program, where we're distributing social security and veteran administration funds. That opens up other opportunities that we're talking about with BNY. Wells Fargo is a huge supporter. Citi is a huge supporter. So we've got sort of commercial banking support on the B2B or the distribution level. And that continues from a CRA perspective, at least for the near future. So there is a CRA component where a program like an On Our Block is an innovative program that sort of fits the CRA guidelines. So we think we can continue down that path. I mentioned sort of CDFI fund and treasury and us positioning ourselves to be able to leverage CDFI and related dollars that are still mandated and on the books that we don't think are going anywhere, that will give us a capital base to then partner with folks who are still committed to social and economic justice. And then leveraging technology along with that capital stack, we believe we can do that in a cost-efficient way, certainly for the near term, 1 to 2 years to continue our work. So that's how we think about it. And then just from a pure business model perspective, city government, nonprofit, state government, now federal, are paying us to distribute funds. So that's not going away necessarily, right? Like there are programs that need to get funds into the hands of folks. And we have really a robust sort of innovative fintech platform to be able to do that in a cost efficient way. And so we think we're positioned well to do that in the near term. But for sure, looking at a change in administration, change in priority, there are some curveballs that we think will come or some adjustment that has to come. But I think also just leveraging tech and being able to do that in a low cost way and just continuing to stand on our mission. I mean, at the end of the day, we have a mission to really put, an economic framework next to a social justice framework. And we are not straying away from that quite frankly, no matter who's in office and what the administration is. And so we're going to stand on that and be smart about doing that in a cost efficient way, in a way that makes sense for our business and allows us to scale. And so we'll just continue to do that. And we've been banking this market before the current political climate where we've had to be low cost and had to think out the box on how we get to folks. And so I think we're hard and in position to do that if policies and initiatives may change. But I think we're in a good position to do that.
To your point, I mean, you guys have had to make a lot of pivots as a business. And I just, as sort of a parting question, would love to hear from you. Like, what's the number one lesson or takeaway that you've experienced in doing this work? Like, what insight have you really gained in your time at MoCaFi?
Number one of utmost importance is that there are credit-worthy, ingenuous people in Black and brown communities, underbanked communities that deserve access to capital and would make for qualified, positive return investments on that capital, right? And we just have to be diligent and creative in how we reach the community and get over the barriers of trust that are warranted, get over some of the barriers in how we underwrite and due diligence borrowers in financially vulnerable circumstances. The tools are there, the technology is there. We just need the will and good people to do that. And we can do good business and make good business doing it. I think that's the number one lesson learned. And we've seen that through our distribution programs. We've seen it just one-to-one. I can think of, I can't say names, but I can think of, and I call them personas, but they're not personas, folks that we've just talked to who would surprise an institution who may not be looking to bank these folks to say, hey, there are credit-worthy borrowers in the community, and we just need a way to get capital to them. I think that's just the number one lesson. Yeah.
And Steve, we mentioned earlier thinking through the partnerships, the other players in the market. So we like to ask, if you could speak to the innovators out there, if you could speak to the other entrepreneurs like yourself and Wole, what business do you wish existed that doesn't exist? Because you got to focus on what you got to focus on. What do you think is a good area that somebody should be building a business in right now that maybe you haven't seen or you don't see?
One-click acquisition of real estate on a fractional level, protected, so that we give folks who may not be ready to buy a home, but give them access to an asset to start building wealth.
Right on.
How about
that? Yes.
I mean, first of all, not only have you warmed our hearts by mentioning many of the great cities in the Midwest, including Cleveland, which I love, but mentioning fractional real estate for Jeremy and I is a true treat. So thank you so much for joining us.
Thank you, Steve.
That's going to do it for this episode. Hey, all of our listeners, we'd love to hear from you. Please send us an email at podcast@thehousinginsiders.com. If you have questions or comments, happy to pass them along to MoCaFi. And if you like what you hear, please leave us a review.
Always share and subscribe so we can do this again. Thank you so much.